A woman named Karen spent 30 years doing everything the right way. She maxed out her 401k every single year, never missed a contribution, never panic sold during a crash. She followed every piece of advice her financial advisor gave her, and she did it faithfully, without question, for 3 decades. At 62, she sits across from that same advisor and learns she has $680,000. He nods. He smiles. He tells her that's a great outcome. What he doesn't tell her is that she should have $1.1 million. There's $420,000 missing. No one stole it. No market crash swallowed it. No bad bet destroyed it. It evaporated, 1% at a time, every single year, for 30 years. What's the pattern? They all believe the same lie, that fees are small, fees are normal, and fees are the price you pay to have a professional managing your money. 1% sounds like nothing. It sounds like a rounding error. It is not a rounding error. It is a silent, compounding machine running in reverse, and it's been running inside your account every single day since the day you opened it. My name is Mano, and I spend way too much time thinking about the hidden costs that the financial industry buries in footnotes and prospectuses that nobody actually reads. I've got multiple hundreds of thousands of dollars invested myself. I've made most of the mistakes in this video personally before I understood what was happening. If you're someone who has a 401k, an IRA, or any kind of managed investment account, and you've never actually sat down and done the math on what you're paying, subscribe and like this video. It will help more than you think. Here's what we're actually doing today. I'm going to show you exactly how a 1% annual fee destroys compounding over a 30-year timeline, with real numbers, not theory. I'll walk you through the difference between expense ratios, advisor fees, and the third fee that almost nobody knows about, called the fund's internal transaction cost. I'll introduce you to something I call the fee drain effect, the compounding in reverse phenomenon that turns small annual percentages into 6-figure losses. I'll show you the specific dollar amount that the average American investor loses to fees over a working lifetime. And I'll give you a 3-step process to audit your own accounts tonight, accounts that might be quietly hemorrhaging money right now, so you can see the damage for yourself. Think of your retirement account like a fruit orchard. You plant trees. Every year they grow and produce fruit. The goal is that over 30 years the orchard becomes massive, hundreds of trees, thousands of pieces of fruit, more than you could ever eat. That's the compounding dream. Now imagine there's a groundskeeper. He maintains the orchard, walks the property, keeps an eye on things, and his payment structure is this. Every single year, he takes 1% of everything the orchard produces. Not 1% of his work, not a flat fee, 1% of every single piece of fruit, every single year from every single tree, including the trees that grew from the fruit he already took a cut of last year. That's what a fee does. It doesn't just cost you the 1% you hand over. It costs you the compounded growth that 1% would have generated for the next 20 years. The groundskeeper gets paid. You get the bill for the rest of your life. To understand why this matters so much, you have to go back to the 1970s, because this is not a new story. In 1974, Congress passed something called ERISA, the Employee Retirement Safety Act. Before ERISA, most American workers got pensions. Your employer managed a pool of money, you worked 30 years, you got a check every month until you died. Simple. The employer bore all the investment risk. Then, in 1978, buried inside a tax bill that nobody was paying much attention to, a small provision called Section 401k was added to the Internal Revenue Code. It was originally designed as a way for executives to defer part of their salary into investments, a tax loophole for high earners. A benefits consultant named Ted Benna is the one who figured out that regular employees could use it too. By 1983, about half of all large U.S. employers had adopted 401k plans. By the 1990s, pensions were being phased out almost entirely. Here's who won: employers, who transferred all investment risk onto employees and eliminated the guaranteed retirement liability from their books. Financial services companies, who now had access to hundreds of billions in new assets they could charge fees on. Here's who lost: workers, who went from a guaranteed monthly income in retirement to a do-it-yourself account loaded with options they didn't understand, managed by institutions that had every incentive to profit from their confusion. So what does this have to do with fees? Everything. Because the 401k system was not designed for your maximum benefit, it was designed for maximum participation, and the fee structure built into the system reflects exactly that. Here's where the math goes from tricky to punishing. There are 3 layers of fees in most 401k accounts, and most people only know about one of them. The first layer is the expense ratio. This is the annual cost of owning a mutual fund or ETF, expressed as a percentage of your total balance. The average actively managed mutual fund has an expense ratio of about 0.68%. Some go as high as 1.5%. Vanguard index funds charge as low as 0.03%. That difference from 0.03% to 1.5% is not a minor tweak. Let's run it. You invest $500 a month starting at age 30. By age 60, at a 7% gross return with a 0.03% expense ratio, you have approximately $567,000. Same contribution, same 7% gross return, but with a 1.5% expense ratio fund, the kind your advisor might put you in, the kind that dominates most 401k menus, you end up with approximately $382,000. That's $185,000 gone, quietly, silently, to a fund that likely underperformed the index anyway. That's the first layer. The second layer is the advisor fee. Many Americans work with a financial advisor who charges 1% of assets under management annually. At first blush, 1% sounds reasonable. Professional oversight, financial planning, someone to call when markets panic. But run the math over 30 years. Take that same $500 per month investor at age 60 with no advisor fee on top of a low-cost index fund, they have $567,000. With a 1% annual advisor fee dragged against the portfolio every year for 30 years, they end up closer to $430,000. The advisor took $137,000, not in some lump sum robbery, 1% of your growing balance every year, compounding against you. Now add the first layer and the second layer together, a 1% advisor fee on top of a 1% expense ratio mutual fund, and you're losing roughly $280,000 over that same 30-year period, compared to a low-cost index fund approach at the same 7% gross return. But here's the part that actually breaks people's brains. There's a third layer. It's called transaction costs, or the portfolio turnover cost, and almost nobody talks about. Actively managed funds don't just sit still. They buy and sell securities inside the fund constantly, sometimes turning over their entire portfolio multiple times a year. Every time they trade, there are commissions, bid-ask spreads, and market impact costs. These don't show up in the expense ratio. They're not disclosed in most fund marketing materials. A 2013 study published in the Journal of Finance estimated these hidden transaction costs averaged an additional 0.14 to 1.44% annually, depending on the fund. Some high turnover funds are paying close to 1% per year in hidden transaction costs on top of their stated expense ratio. Add all 3 layers together in a bad case: 1.5% expense ratio, 1% advisor fee, 0.75% hidden transaction costs, and you're paying 3.25% annually in total friction costs against a portfolio that might be returning 7% gross. Your net return is now 3.75%. Run that scenario for 30 years and compare it to someone paying 0.05% total on a simple index fund at the same 7% gross return. The difference is not $185,000. It's not $280,000. It's over $400,000. That is not a fee. That is a second retirement account that you built for someone else. Let me make this real. Meet David. He's 35, software engineer, makes $95,000 a year. His company offers a 401k with a 4% employer match. He contributes 6% of his salary, $5,700 a year, and captures the full $3,800 match, bringing his annual total to $9,500 invested. He's been doing this since he was 28. His company's 401k plan, like most corporate 401k plans, is administered by a large financial services company, and the default fund options are mostly actively managed mutual funds with expense ratios between 0.75% and 1.2%. His advisor recommended the Balanced Growth Fund with a 1.08% expense ratio. Sounds reasonable? David nods, moves on with his life. Now let's contrast David with Linda. Same age, 35, same salary, $95,000, same company, same 401k, same $9,500 annual contribution. Linda took 45 minutes one weekend to read about index funds, switched to a total market index fund with a 0.04% expense ratio, and never thought about it again. Both David and Linda invest for 30 years. Both earn the same gross 7% annual return. At age 65, Linda has approximately $940,000. David has approximately $760,000. Linda's 45-minute research session was worth $180,000. That is $4,000 per minute of effort. But here's the kicker. David's $760,000 estimate is actually optimistic, because it only accounts for the expense ratio gap. If David also pays a 1% annual advisor fee on top of that, his balance drops to closer to $590,000. Linda's total investment in time and cost? Under $100 in the book she bought to learn about index funds and a free Sunday morning. David's cost? $350,000, paid silently across 3 decades to people he trusted to be on his side. Mock dialogue time. David goes to his annual review at 62. His advisor, Jeff, has a nice office. There's a view. There are framed credentials on the wall. David, staring at his balance of $630,000, Jeff, I ran some numbers this weekend. If I'd been in a simple index fund this whole time, I'd have about $900,000 right now. What happened? Jeff, leaning back in his chair, clicking his pen, well, David, the market has been volatile. We've been actively managing your downside risk. David, the index fund also beat your fund by 2.3% per year on average. Jeff, past performance doesn't guarantee future results. David, the index also didn't charge me 1% every year. Jeff, our comprehensive planning service includes a lot more than just fund selection. David, like what? Jeff, have you thought about long-term care insurance? The call ends. Nothing changes because it's too late to change. That's the tragedy. Not that Jeff is a bad person. Jeff probably genuinely believes he's providing value. The problem is structural. Jeff makes money whether you win or lose. His income is 1% of your assets, not 1% of your gains. He gets paid even in the years where the market drops 20%. That's not a conspiracy. It's just incentives. And incentives shape behavior at every level of the financial industry. Here's the part nobody talks about. The reason fees are so effective at staying hidden is not a failure of regulation. The fees are disclosed. They're in the prospectus. They're in the fund fact sheet. They're technically visible. The problem is that the human brain cannot intuitively grasp the compounding effect of a percentage on a future number that doesn't exist yet. If someone told David at age 28 that he was going to hand $350,000 to his financial services firm over the next 37 years, he would have demanded to see that number in writing. He would have shopped around. He would have asked serious questions. But nobody frames it that way. They frame it as 1%. 1%. You know what 1% looks like in year one when you have $20,000 in your account? It's $200. That's what you paid for the service. $200. Seems fine. Seems reasonable. What your brain fails to calculate automatically is what that $200 would have grown into by year 30, or year 29, or year 15, or every single year in between. The financial industry knows this. They know that percentage-based pricing hides the true cost in a way that flat dollar pricing never could. If your advisor sent you a bill every December 31st that said your fee this year is $8,400, which is what 1% on an $840,000 portfolio looks like, you would comparison shop. You would demand performance. You would make an informed decision. Instead, it's deducted from your portfolio automatically, usually quarterly, usually displayed as an NAV reduction that looks like normal market fluctuation. It disappears into the noise, and the industry has every reason to keep it there. Here's what you can actually do about this. Tonight, not next week, tonight. Step 1. Find your expense ratio. Log into every investment account you have. Look up every fund you own. Google fund name expense ratio. If any of them are above 0.20%, you are overpaying. The three biggest low-cost alternatives are Vanguard Total Market Index, VTSAX or VTI, Fidelity's Zero Funds at 0.0% expense ratio, and iShares Core S&P 500 ETF, IVV, at 0.03%. There is no actively managed fund that has consistently beaten those options over a 20-year period after fees. Not one. That's not my opinion. That's what a 2023 S&P SPIVA report found. Over a 20-year period, roughly 95% of actively managed large-cap funds underperformed their benchmark index. Let me be very clear about what that means. You are paying more money to people who are producing worse results than a fund that charges almost nothing and requires zero human management. That is what the data says. Step 2. Understand your advisor's fee structure. Ask them directly, are you a fee-only fiduciary or do you earn commissions? A fee-only fiduciary is legally required to act in your best interest. A commission-based advisor earns money when you buy products, and that changes the advice they give, whether they consciously intend it to or not. If your advisor earns commissions, that is not automatically disqualifying, but you need to understand the incentive structure before you take the advice. Ask for a complete fee disclosure, in writing. If they hesitate, that hesitation is the answer. Step 3. Run the numbers on your own account. Take your current balance, your expected annual contribution, your advisor fee, and your fund expense ratios. Run two scenarios, your current setup and the same contributions in a low-cost index fund with no advisor. The gap you see is your fee drain number. That is the money you will lose if nothing changes. Some people look at that number and decide the advisor's value, behavioral coaching, tax optimization, estate coordination, is worth it. That's a legitimate choice, but you have to make it as an informed choice with the actual dollar amount on the table, not as a passive default you never questioned. To be fair, not every financial advisor is a bad deal. If your advisor is providing comprehensive tax optimization, helping you navigate Roth conversions, managing Social Security timing strategy, and keeping you from panic selling in a crash, that service has genuine dollar value that can exceed the 1% cost. The problem isn't advisors. The problem is advisors charging 1% for services that consist almost entirely of recommending high-fee mutual funds and sending quarterly statements. There's a real version of financial advice worth paying for. Most people aren't getting that version. They're getting the version that exists because it's profitable to sell, not because it's optimal for them. And the worst part is, they have no way to know the difference, because nobody teaches this. It's not in school, it's not in the financial media, which is funded by the very institutions that benefit from the confusion. The information exists in SEC filings, in academic literature, in the data Vanguard publishes on their own website. but you have to know to look for it, and most people don't know what they don't know. Here are your 3 takeaways. 1. The fee is not 1%. The fee is 1% compounded annually against a growing balance for decades. On a 30-year timeline, a 1% expense ratio difference alone can cost you $180,000 to $420,000 in lost final balance. That is not a fee. That is a financial decision that deserves the same level of scrutiny you'd give any $400,000 purchase. 2. You are almost certainly in at least one high-fee fund right now. The average 401k menu is dominated by actively managed funds with expense ratios that are 10 to 50 times higher than low-cost index alternatives. The default option at most employers is not the lowest cost option. It's the option the plan administrator has a relationship with. Check tonight. Switch if necessary. It takes 20 minutes and costs you nothing. 3. Ask the fiduciary question. Before you take any financial advice, ask whether the person giving it is a fee-only fiduciary legally obligated to act in your best interest, or someone who earns commissions from the products they recommend. These are not the same thing. They may look identical from the outside. The incentive structure is completely different. You deserve to know which one you're working with. And subscribe if you haven't already. The next video covers something that makes this one look almost friendly. Peace.